Hello, everyone. Welcome. Thank you for tuning in. We're going to be continuing a series that we've done over the last several years. In this series, we have highlighted and focused on a specific theme or a specific topic that we believe has substantial relevance to a 1031 exchange and DST investor. And this is actually a topic we've never done before, so I'm excited to dive in. But before I introduce our topic, I want to welcome Orrin Barrow to the conversation.
Thank you for having me.
One of our senior vice presidents, has been with the firm for a really long time, so excited to dig in here with you, Orrin.
Yeah, very excited to dig in as well. I think that risk awareness is something that almost every single investor in the KPI 1031 universe and has had access to our platform will see and ask both myself and Matt, hey, what does this mean? And it actually carries a number of different meanings. So we're going to get into a good amount of those here on the call today.
Yeah, absolutely. And this call or this topic rather was kind of brought up by questions that we get asked on a daily basis from our investors, specifically those that have logged into our website and interact with the current offerings that we have available. There are different flags that we attach to different offerings to raise investors' awareness level to certain aspects of certain offerings. And one of the flags that we have associated with some of the offerings is a risk awareness flag. So this is really the genesis of this conversation, is responding to a very common question that we get asked: what does that mean?
Right. What does that mean?
And on a high level, the response is fairly straightforward. It means there's an element of risk that we believe is worth noting on that particular offering. But there are actually a number of different categories that draw out additional risk in the context of a specific real estate investment, in the context of a DST. So we're going to shed some light on some of the different aspects of a deal that could lead it into that risk awareness category, so to speak.
Absolutely.
So I think that maybe we'll start with the most obvious, and we can just kind of go down the list here.
Right.
Is the debt structure, right? The debt structure on a deal. And I think what would maybe be helpful, Orrin, if you can provide a little bit of context and a point of relativity as it relates to each of these aspects, that I believe would be really helpful, just so investors have and listeners have a kind of a proper context as to what we're talking about. So maybe if you can introduce what's the typical debt structure that we see on a DST? What types of investments are we most comfortable with debt, and what types of debt would lead an offering to be flagged as risk awareness?
Right. Yeah, I think that makes a ton of sense. So there's two, just to kind of take a step back. There is usually, when they see the risk awareness tag, there'll be a risk awareness tag, and there also will be a heightened risk awareness tag. And that just essentially means that when we compare these particular DSTs to your traditional DSTs with traditional financing, traditional business plans, they have a heightened level of risk, or risk that we want investors to be aware about. So just kind of getting into the debt structure, typically what you'll see in a Delaware Statutory Trust that has debt is you have 10-year financing. Now, depending upon interest rate levels, there may be more IO, meaning interest only, versus some amortization. We're seeing in the marketplace today that a number of the offerings that have debt are doing interest-only financing, and because of the cost of that debt, they want to be able to make a compelling and viable product and have the cash flow be at a certain level to pay out investors for parting with their capital. But they also want to be able to pay that debt and service that debt in the way that they see fit to be able to achieve those objectives. So typically you'll see 10-year financing. Some of it might be interest only. Some of it might be start to amortize, usually in years 2, 3, or 4. Amortizing means starting to pay it down like you would pay your regular house note down. And then traditionally, when you take that debt structure and put it in a Delaware Statutory Trust, the ability to execute the business plan within 7 to 10 years is highly likely, right? We have a good track record of sponsor companies being able to look at their their actual business plan and be able to execute it within a 10-year period, right? In that 10-year period, you're able to sort of grow the value, look at the submarket, let the submarket demographics start to trend upwards, and then make potentially what is a profitable exit when the deal sells. But when you have financing that's going to be 7 years, 5 years, will start to really shorten that window up. It doesn't give a lot of room for mistakes on behalf of the sponsor company to truly execute their business plan and grow that value, right? When you've got variable rate mortgages, which is rare, but it can happen when we see DSTs or variable rate mortgage, where the asset managers are trying to take advantage of maybe a lower rate in the present and then possibly having a higher rate in the future that can really eat into investors' cash flow and have the operations of the property suffer. That's something that we're going to flag as risk awareness, right? And so in terms of the type of debt, a lot of times certain types of debt, CMBS included, can sway the balance of how that property or how that mortgage is going to be serviced, and therefore can cause a real strain on the operation of the asset classes towards the latter end of the hold period. So debt structure is really, really important. We tend to be very, very prudent when we're taking on debt. So you will also see a lot of assets that are single tenant net lease or single tenant net lease industrial with debt financing will typically be on the risk awareness side as well. And it may not necessarily be because of the term. It's just that when you see any kind of failure rate in DSTs, which there's not a ton, right? I don't want to scare investors thinking that, 1 out of every 5 DSTs fail. That's not the case. However, DSTs that have returned back less than investors' principal, have cut cash flows for an extended amount of time, almost all of them exclusively have debt on the property. And a lot of them fall within that single tenant net lease industrial asset class. And the reason why is pretty simple. When you have a multifamily property, you have a tenant base that is diverse, right? You have a number of different units. The units that are usually associated with multifamily properties can range anywhere from 150 up to 500 units, a lot of times in many of the multifamily properties that we have on our menu. So that you're not going to have a cascading amount of vacancies happening at one time unless you have a huge employment failure in the marketplace or a bankruptcy in the marketplace, which is unlikely. So you're not going to have an occupancy level that goes from 100% to 0% overnight in a multifamily or multi-tenant asset. You can have that happen in a single tenant net lease industrial, and that can cause the lender to want to enact a sweep on any cash flow that's left over or foreclose on the asset. And so usually you'll see that even though it might be more traditional financing, if it's attached to single tenant net lease industrial, it could end up on that risk awareness tag.
Yeah, I think that was really well said. And a way that I look at debt and describe debt is it can be your best friend or your worst enemy, right? Depending on the environment and the context of how that debt is acquired. One of the additional components of debt in terms of its interaction with the DST is it's very difficult to refinance a DST.
Right.
It's actually one of the 7 deadly sins that the IRS puts forth. So we want to be really careful with respect to the term because the debt places somewhat of a backstop, on the DST and influences the sponsor company's timeline of when they can achieve an exit like you described, Orrin.
Right.
So the debt's really important with respect to term, as you mentioned, the interest rate part of it as well, fixed versus variable rate.
Right.
99% of DSTs are fixed rate financing. Every so often, there may be a variable rate. We want to flag that for obvious reasons, right? It's very difficult to project future borrowing costs in different segments of the economy, and that could directly impact the performance of that property. And then the types of debt, right? The CMBS debt, which is more common with commercial properties, tends to be more onerous in terms of its term, right? So it's much easier for a lender to implement cash flow sweep provisions, which could drastically impact that property's ability to pay a cash flow to investors, release the property, et cetera. So I think all in all, we're most comfortable with debt in the context of a DST with multifamily properties, long-term 10-year fixed rate financing.
Correct.
Is what it comes down to.
That's usually going to give the sponsor company the breathing room to operate and be able to fulfill the business plan as they expected.
Absolutely. So to continue down the list here, and these other categories we might not have as much to dig into.
Yep.
Can you talk a little bit about certain sponsor companies and why we may attach a risk awareness label there?
Yeah. So just like we mentioned before, risk awareness can mean many different things. It's not a cookie cutter model that we add to every single deal. So we could see a property, a DST that we feel like is viable, but it is with a newer sponsor company. Now, not all newer sponsor companies are equal. Many times the sponsor companies are just entering the Delaware Statutory Trust space, but they've had years and years of syndications under their belt. So they're just moving into another structure versus moving into another business model, right? And so for those sponsor companies, if they are showing us the requisite track model to be able to give us confidence, we may or may not have them on the risk awareness tag, but there are newer sponsor companies that come in with really no syndication experience, no Delaware Statutory Trust experience, and are not necessarily versed in syndicating the type of deals that are attractive to DST investors. And so when those kind of sponsor companies come on the scene, I think it's incumbent upon us to let investors know, hey, there's going to be a higher level of risk here. They don't have an entrenched sort of position in the overall marketplace. Potentially, they could be here today and then no longer do DSTs 2-3 years from now. As a registered representative, I want my clients to be in offerings with sponsor companies that are going to be here for the long haul, going to continue to have investor relations departments that are going to be communicating with the investors on a quarterly or monthly basis. And so that means a lot to me in terms of sponsor experience. And I think a lot of the investors that come to us are looking for the context of which sponsor companies have been doing it for an extended amount of time, who's been successful. So, if you're looking at a deal and it has all the requisite items that would make it not risk awareness, but we have the tag, it may very well be that the sponsor company has relatively new experience in that marketplace, in that asset class for whatever reason.
Yeah, I think that was well said. And track records, really, really important as it comes to this. When we do our due diligence on any new offering, one of the main things we focus on is doing due diligence of the sponsor company, right? So we're looking at their background, their previous operating histories, looking at if they've been involved, in any adverse situations, lawsuits, things like that. There's a whole process that we go through when we're vetting, these various offerings. And there are situations where there's a newer sponsor company that maybe doesn't have track record in the DST space, but has track record in, other spaces, other types of investments. But we just might not have the familiarity of how they operate as a company. And because of that, we want to draw our investors' attention to it.
Right.
It may be significant, it may be insignificant at the end of the day, but our role is to educate and to draw these things out and, filter through the nuance as it relates to the different offerings. And I think the sponsor track record and this significance they have to the DST space is something to pay attention to.
Yeah, absolutely.
So let's keep moving here. So can you touch on another aspect has to do with the ownership structure of how the real estate is owned,
right?
And then also tax structure in certain cases and why there can be flags, the risk awareness flag associated with either of those.
Yeah, absolutely. So in terms of ownership structure, one of the two things we wanted to highlight on this particular talk is the leaseholds and tax abatements. Okay? Mm-hmm. So leaseholds is effectively you're not owning the land, you're just owning the actual building. And we look at that as potentially having less viability in the future, right? Most investors are buying real estate, and that includes larger investors, large REITs, large institutions, as well as mom and pop investors like the ones that are going to be listening to this type of call. You usually want to own the land, right? And so ultimately, if you are not able to provide that land upon exit of the asset, it's going to shrink the pool of buyers. And depending upon what market environment you're in, if you're in a market environment where interest rates are low, demand is through the roof, you can still probably have a profitable exit. And that doesn't necessarily mean that it won't be profitable in those circumstances. But as we all know, as interest rates go up, as inflation goes up, as the cost of living goes up, it all makes the ownership and the interworkings of real estate harder to manage. And if you're not able to own the land, it might make it viable or less viable to a point where you're not necessarily having a profitable exit, or you have a limited buyer pool. And so the amount in which you can sell it for has a ceiling. And so we tend to look at those things. This won't necessarily make us eliminate a deal from contention. And that's why we have the risk awareness tag. So we can place that tag on investments that might be suitable for a specific type of investor with maybe a higher risk profile. In terms of tax abatements, right, you are getting your expenses reduced, right, by bringing down or eliminating that a property tax bill at the first onset of the ownership of the asset. And so that allows for you to have more free cash flow. Usually it's going to have a higher cash flow associated with it. Obviously, we're in the business of tax deferral, and so any sort of tax deferral outside your regular expense write-offs is going to be advantageous at the front. However, when those subside, you'll typically have a jump in your overall expenses, because now property taxes have to be a consideration on that expense sheet. And that can really hurt the viability of the cash flow in those later years when that property tax comes back. And so it's important to note those things, right? You might be taking advantage of a tax abatement in the first couple of years, and then we have to be reasonable and conservative. And what does that look like when we have to start paying property taxes? Is this property going to be viable enough and cash flow sensitive enough to be able to continue paying out the investors even when that new expense comes online? So we flag those kind of assets with risk awareness so investors are aware, and it can make informed decisions about what they want their next, not necessarily first 2 years, but maybe the next 5 to 7 years look like as a Delaware Statutory Trust owner.
Yeah, I really liked what you said about looking at it from a big picture standpoint, because both the leasehold interest and tax abatements have some advantages, right? Especially immediate advantages. I mean, the leasehold interest, you're not paying property tax because you don't own the or on the land part. Tax abatement, you're not paying property tax, or you're paying a reduced property tax. And we've seen a lot more of the tax abatements more recently because of all the development that has kind of cycled on over the last couple of years, specifically in certain markets that are incentivizing developers to build, right? The municipalities are offering, certain tax abatements, and we really want to look at it from a bigger picture standpoint. Yes, this advantage is here now, and that's great, but how does that translate to the future value of the property, or how the next buyer is going to approach that particular holding with a reduced abatement period, or once that abatement period runs up, and as you stated, the expenses rise, on the property accordingly. So once again, it's not, all of these things inherently are not deal breakers in and of themselves. It's just something that we want to dig into and make sure the risk reward element is worth it for that specific investor. Yeah,
absolutely. Investors, I think, need to be aware. That's one of the tenets of our job, is to make investors aware of all of these so they can make informed investment decisions. And our due diligence team and our upper level management does a good job of flagging these items so investors are aware.
Absolutely. So this next one we talk about a lot, and we don't have to get into all the details, but exit strategy, specifically around the 721 exchange. You want to dig into that a little bit?
Absolutely. And I think we have talks like this in detail about the exit strategy. So please refer to those talks if you want more of a detailed sort of open forum conversation like the one we're having now. But effectively, the 721 forced exits are something that upper level management, due diligence, as well as representatives like myself and Matt usually are going to have an issue with outside of very specific customer base, right? And so, as a firm, we believe a lot in optionality. There are firms that also believe in that optionality. So that's really great that we have some options where investors can choose at the end of the whole period of the Delaware Statutory Trust whether to perform another 1031 exchange and go into another DST or their fee simple property, or go into the overall 721 exchange vehicle where they'll be able to perform a 721 exchange. Having that optionality gives the investors the control that they're looking for when it comes to an exit strategy. A forced 721 exchange means that you're investing inside the Delaware Statutory Trust knowing that your proceeds are going to be going up into the 721 vehicle. And the issue with that is valuation, right? What value are you buying the REIT at the time of the 5 to 7 years? And A lot of times the REITs are marketed as something that has a large amount of liquidity, but that really depends on the economic environment that we're in. If REITs are struggling, if DSTs are struggling to be able to operate effectively, they can gate those redemptions. And so you going into a REIT, you're forced into that up REIT. Now you're a part of that REIT hoping that you had liquidity, and it doesn't always come to fruition, right? And so it's just important to note if you have the ability to have optionality, we always press that. Obviously, some investors are going to be looking for the forced up REIT because they want their final destination to be in a REIT, and for a specific type of investor that might make the most sense. But for most of them, it doesn't. And optionality, I think, is key when you're talking about the 721 exchanges. So usually when you'll see a forced 721 exchange, it will have that risk awareness, and many of them have the heightened risk awareness tag because the REITs are currently not performing as expected. So if you're sort of baking yourself in or kind of putting yourself in the box of having to go into that REIT, there could be adverse situations happening down the road.
Absolutely. Yeah, well said. The only thing I will add to that, and you touched on this too, Orrin, is with the 4721s, our biggest concern is the inability to do proper due diligence at time of entrance. Right. So you're doing due diligence on a REIT today that you will likely end up in 2 to 3 years from now.
Right.
And the performance over the next 2 to 3 years and how that REIT is positioned at that time, it's impossible to know exactly what that's going to look like. And that's just a really difficult, it's very difficult from a due diligence standpoint to approach it that way.
Yeah.
So let's move on. Asset class. Can you talk about certain asset classes that have higher risk associated with them?
Absolutely. Before the risk awareness tag existed, there are certain asset classes we just did not touch. And pretty much every call that I would have with an investor, I'd touch on the asset classes that we did not touch. Now the risk awareness tag is something that we have kind of proliferated throughout the menu and the back end of the website. But ultimately what Matt's talking about is there's certain asset classes that we're just not going to do. But then there's also certain asset classes or a specific offering that is a part of the asset classes we normally won't do, but because we feel like it might be viable for a specific investor, instead of just taking it off the menu entirely, we have a risk awareness tag on it. And usually that's going to include student housing, hotels, memory care, high medical assisted living, where there's usually some sort of medical professional or personnel that's also a part of the assisted living community. And then oil and gas, right? So oil and gas, we don't really do that at all. We haven't necessarily found a ton of viable offerings that are on the actual marketplace to want to add that to our firm, even with the risk awareness tag. When it comes to student housing, hotels, and assisted living, obviously those are going to have a heightened level of risk attached to them. But we want to have that risk awareness tag on them because these are really operational asset classes that also have seasonality attached to them. They also haven't performed from an historical standpoint. They haven't performed as well as some of the other classes during downturn or bad economic environments. And so unless an investor really has a specialty in which they've invested in those asset classes before and can have the sophistication to know the type of risk that they're taking on. These are asset classes that, as a representative, I stay very far away from unless an investor can demonstrate to me they have sophistication with buying these asset classes, because they can have pitfalls, and the risk awareness tag is there to sort of identify those pitfalls.
Yeah, I think that was well said. And to take a step back for just a second, I think the priorities for most DST investors is preservation of principal first, consistency of distribution second, and hopefully some modest, appreciation.
Yep.
And because these asset types are so operationally intensive, it can make it very difficult to achieve a smooth investor experience as it relates to the cash flow that they're able to generate over the holding period. And to your point, because they're slightly more exotic, asset classes, the kind of spread in value can look very different in different segments of the greater cycle.
Absolutely.
Which could also affect, the investor in both a positive and negative way. And I think what I get to with all of this is this idea of risk premium, right? And this is a conversation I have with all of my investors is the extra risk you're taking on in any one of these offerings, are you being adequately compensated for that risk?
Right.
That's the question that you have to ask.
Yep.
And a lot of these hotel, related offerings, assisted living, student housing, they're not inherently bad deals, right? We just may not believe that the risk reward or that idea of risk premium is really there in the context of if you compare them to other maybe more core asset classes.
Right.
I think that's what it comes down to.
Absolutely.
Okay, so the last two, as we wrap up here, can you touch on location and then also credit quality?
Yeah, I mean, the location obviously matters. I think that there's the saying location, location, location when you're talking about purchasing real estate. If you have demographics that are moving upwards, then it matters. If you have a diverse amount of employment in the actual area, then it matters, right? So when you'll see a risk awareness tag on an asset, a lot of times it might be a situation where there is limited economic drivers in an overall market. You might have you might be in Texas and the entire market is based around the Permian Basin and the oil industry, or you might have a place in Vermont where Virginia, where the entire sector is focused on the AI build out, or a medical network that's entrenched in that particular submarket. And then you'll look at your tenants and you'll see that 80% of them work in that medical network, or 80% of them are focused in the oil industry. And we all know the industries have boom and bust cycles. The entire economy is based on that model. And so you have times where those economic drivers are working, and then you may have times where that health network is facing competition. The price of crude oil has gone down considerably, and that overall industry is suffering to have the same margins they had in the past. And so that will affect your overall multifamily property. Make no mistake about it, the multifamily environment is not going to be protected from a very large employer in the area where most of your tenants are making their money from. If they have some sort of adverse reactions to the overall marketplace, your multifamily property can suffer. Your multi-tenant shopping center can suffer. Your small bay industrial can suffer if a lot of your tenants are focused there. And it's just important to note that you want economic drivers, diverse economic drivers in an overall marketplace, because it provides you with some sort of insulation from overall market forces, that you can still have a population of renters and tenants that can still function even though we might not be in the best economic environment. In terms of like credit worthiness and tenants, obviously when you have a long-term industrial property, your property is going to have more value the more credit worthy your tenant is. The more credit worthy your tenant is, the more that you can be assured of less volatile payment structures, so that this particular tenant has $1 billion balance sheet backing the overall tenant. Getting rent is very, very easy, right? When you've got private tenants or less than creditworthy tenants, then collecting rent, especially during downturn or hard economic times, can be very, very difficult. And you can go a couple of months without collecting rents because the operation of the business are just not where they need to be in order for them to make rent on time. And so those are some things that we look at as well. And if we feel as though it's severe enough to have a risk awareness tag, or it's something that investors, that is a direct and critical part of the overall offering, we'll bring that to your attention so you have an idea of what you're putting your money into.
Yeah, and I think with the tenant risk specifically, with a single tenant, commercial property, whether it's retail, industrial, medical, whatever it may be, this is much, much more important than, say, a very diversified, industrial small bay type property, right?
Absolutely.
And it goes back to what you were saying, disruption of the cash flow if the tenant's unable to pay rent, or they become insolvent, or face bankruptcy. And really your main exposure in any single tenant offering is certainly the ability for that tenant to make their payments, but also if they do go bankrupt and they do default, how much time is it going to take to backfill that space? How long is the investor going to go without receiving cash flow? And what other tenants can you attract into that space, and how much are you going to have to spend to get them there, right?
Absolutely.
So for the most part, with the single tenant, offering commercial offerings, high percentage of those are credit quality tenants, kind of your investment grade household name. Occasionally we will have, a private, tenant, And once again, it goes back to that idea of risk premium.
Right.
You know, are you getting adequately compensated
Or the risk that you're
taking on the risk of dealing with private credit in the context of the other offerings that are available or
Right.
what else is available in the market? So
Right.
that was a very long list, Orrin.
Well, you know, risk awareness, we've got a number of risks that, I mean, at the end of the day, all investment associated with Delaware Statutory Trust have risk factors associated with them. But like Matt was saying, there's a traditional model that we feel like has a better chance of protecting investors' capital. And so we don't have those risk awareness tags, but obviously with other risks that we've mentioned here throughout this talk, you want to be aware of them. And I think we're doing investors a service by having that ribbon and that flag on top of all the investments that have some of these things that are not necessarily in line with the traditional Delaware Statutory Trust. And doesn't necessarily mean that it cannot be for you. It might match your needs and what you're looking to do with your particular 1031 exchange, but at least you're aware of the risk before investing your hard-earned dollars into that offering.
Absolutely. And just a couple comments as we close out here. I think the easiest way to reduce risk in a DST investment is diversification and staying debt-free.
Absolutely.
Right? We continually beat that drum, you know, when we're engaging with investors, because at the end of the day, like you said, there's risk in every investment.
Right.
And we don't have a crystal ball. No one has a crystal ball. We have no way of predicting the future. So if we stick to those core tenets and also pay attention and have informed discussions with investors and investors with the registered representatives like ourselves, that is the best recipe for success at the end of the day. One other thing I'll note before we sign off is I think each of these aspects that we just went through, we could probably host an entire dialogue and discussion on.
Definitely.
So we touched on this very surface level. So I would encourage any of the listeners, if you want to dig into any one of these aspects, please reach out to your K Properties representative. We'd be happy to walk you through them. We do hope that you found this informative. Orrin, thank you so much.
Thank you very much for having me.
And your insights. And we do host these conversations regularly, so please tune in for the next one. Thank you, everyone, for taking the time. And we look forward to speaking with you very soon. Thanks again.
Visit us at www.1031.com for instant free access to exclusive investor resources, including our DST 1031 Exchange Book and the first ever 721 Up REIT book, written by our CEO and founder, Dwight K. You'll also find our Delaware Statutory Trust catalog and investor case studies. The K Properties team has helped over 4,000 investors nationwide, and we're here to help guide you every step of the way. If you'd like to connect with us directly, give us a call at 855-899-4597.